Hello and welcome to Tech for Non-Techies, the only podcast that demystifies the fast-growing technology sector. I'm your host, Sophia Matveeva, Chicago-based MBA and tech entrepreneur. My aim here is to give you the skills, knowledge and confidence to find opportunities in the tech sector, whether that's through founding a company, getting a dream job, or bringing a fresh perspective to your work. This week, we're talking about technology acquisitions. So far, we've talked quite a lot about how you actually make technology products as a non-technical person. So we've had product managers, we've had user experience designers on sharing their expertise. But making a fantastic product is pretty meaningless unless it fits into a really good business strategy. And sometimes business strategy means acquiring companies that fit in with your business strategy. These days, tech companies are not the only businesses that acquire technology startups. We're seeing more and more traditional businesses innovating via acquisitions. So this week, we're going to learn from technology investment banker Paul Quattrocasas, who is the founder and CEO of Aqua Partners. Aqua Partners is a boutique M&A strategic advisory firm, and Paul has advice on over 50 technology and media M&A transactions around the world worth over $25 billion. Paul is also the author of a book which I've recommended as one of my top reads in my Forbes column. The book is called Go Tech or Go Extinct: How Acquiring Tech Disruptors is the Key to Survival and Growth for Established Companies. The book is in the show notes. What you're about to hear is an excerpt of a session that Paul did for Tech for Non-Techies members. If you want to hear the rest of the session and get the learning materials, then all you need to do is become a Tech for Non-Techies member. But without further ado, here's Paul.
I met you when you had just published your book, and that was in the end of last year?
It was about October last year.
Do you want to tell us a little bit about your book, or what it's about, and why you wrote it?
Sure. So the book is called Go Tech or Go Extinct. And the reason that I started writing that, I guess it was back in 2017 when I started, was that we saw the world actually really changing because of tech, not just with smartphones, but in every single industry. And for me personally, it was the Walmart acquisition of Jet.com in 2016 that was just so surprising. It was, Walmart is the largest retailer in the US. It's a very conservative company. They have over 2 million employees. And for that conservative bricks and mortar retailer to acquire an e-commerce company and paying the high price they did, which was $3.3 billion, it was 13 times revenue. Jet.com had only been founded about 18 months earlier, or its website had only launched 18 months earlier. I was just fascinated with that. And as I say in my book, I fell out of my chair, and we did quite a lot of research from that moment about what was going on in other industries as well. And it led to essentially a new business stream for our firm, which is we call Techquisition. But I thought writing a book would help get the word out, and it has been. It's been a long, hard journey, but it certainly helped get the word out about all of this.
So, what does your firm do? For those who don't know.
Sure. So we have always traditionally advised tech company entrepreneurs, CEOs, shareholders, investors, VCs on how to either raise capital or to exit their firm, typically in the form of a trade sale or strategic sale. That's been core business for us for nearly 30 years. The new business, which is this Techquisition business we set up in 2017, is advising large non-tech corporates, established companies. They could be in retail or automotive or banking, insurance, industrial, you name it, advising them on how they can avoid being disrupted, how they can accelerate their market value and remain relevant over the next 5 or 10 years by acquiring or investing in the right tech company to help them become fully digitally or technology enabled. It's a different business, similar theme, but it's really quite a different business. So we focus on those two things.
Well, it sounds like your business is very well prepared to take advantage of the current situation, when I'm sure a lot of traditional businesses are probably thinking, oh my God, what do we buy? What should we acquire?
You would think so. It's probably the source of my greatest frustration at the moment, because many of these established companies are coming out of survival mode, recovery mode, even if they're doing fairly well. For example, if they're in the grocery business, you could argue they're doing fairly well because people need to eat and these supermarkets and so on have stayed open. But they're distracted because they've been so busy adapting to online grocery and online shopping. And not that they weren't doing it before, but they've doubled the amount of that they did in the past. So they're under stress. So the frustration is that you're absolutely right, Sophia. This is one of the perfect times for a large corporate to think about how to reboot their entire 5-year plan and strategy in a new world, in a digital world. We've been going digital anyway, but we've just been turbocharged 5 years forward. And it's a good time to step back and think, well, we just got a glimpse of what the future is going to look like and feel like, and some of it's going to stay. Business travel certainly will not go back to previous levels for a long time. And we could say the same probably about a lot of things, like doing Zoom calls, like online shopping. And so it's an opportunity for these large corporates to step back and think, redraw the map. How do we retool? And can we do it all in-house? Can we do all of this ourselves? Or now maybe is the time to find these really innovative, entrepreneurial, nimble tech companies who, by the way, are attracting real talent, and they're attacking the market differently. They're attracting customers and consumers. Maybe we should really get serious, not just about doing a commercial partnership with them, but actually taking a stake in them, a strategic stake, and maybe even acquiring them with a path to control. And there are all kinds of ways of doing that, but you're absolutely right. This is really a great time to do it. Now, I don't think prices have necessarily come down that much just yet. It does depend on the stage of the company, the size of the company, the maturity, and also the industry sector. But it's probably a matter of time before that changes. I would say that if you had to make a bet, sometime over the next 12 to 18 months, we are going to have a correction in prices of these tech companies, and that presents an even extra special opportunity for the large non-tech companies that would want to make an acquisition.
I already emailed you about what happened last week, which was a leggings company buying a tech company. And all the smart people around me are saying that it's a good idea. And I am skeptical, but I am also aware that I'm not as knowledgeable about it as you. So could you talk us through that acquisition and maybe kind of use it as a case study for,
Sure,
the present times?
Yeah, well, thanks, Sophia. And I think the one you referred to was Lululemon acquiring Mirror Group, or Mirror, the company Mirror, which is interesting that it was our selected deal of the month, or the lessons of the non-tech acquiring tech deal of the month. Mirror, by the way, is this company a little bit like Peloton. The Peloton is the stationary bike. It costs over $2,000, and you get to have it interactive with other people. Well, Mirror is similar. It's an actual physical mirror on the wall where you can exercise, you can do boxing. It's interactive. You can have group sessions, and there's a monthly subscription. And this is actually a company that we showed a couple of years ago to several large corporates who are in the fitness area, and they couldn't get it. They just didn't grasp it for all the reasons that I mentioned. That companies tend to have competing priorities. There's always something else that's more important or in the way, or we can't think about that, or what are we going to do with that, or we don't know anything about tech, or maybe one day this company, maybe one day we could acquire it. Usually by then it's way too late. Mm-hmm. So I always found that especially interesting that here's a company that we recognized early on was very interesting and special, had received funding. Lululemon, which is an apparel retailer focusing on women's clothes and yoga, and yes, they do have a multi-level marketing model, which is interesting and should be looked at. But I think actually, given that that marketing model that Lululemon has, the Mirror deal is even more interesting, because what they are buying with Mirror is technology, intellectual property, as well as a growing customer base paying subscription fees on a recurring basis. But even more than that, it's the synergy between the two companies that makes the deal. But what I was going to say was Lululemon actually invested in Mirror last year. So they participated in the Series B round of Mirror, and I don't know how much they invested, but they took a minority stake. And it allowed, and this isn't the right deal for every company. Every company is different, by the way, in the same way, in my mind anyway, the same way that every person is different. We all have different DNA. Every company has its own DNA, its own culture. And so it should look at every deal in an individual way. And for Lululemon at that time last year, a minority stake, co-investing with other financial investors was the right thing to do. They were also able to learn from its investment in Mirror last October until now, until they made this announcement, a lot more about Mirror, and have been able to work with the company commercially. And they made the decision that this is a company we have to own because it's a win-win. There's so many synergies. And the way that one can validate the win-win is by typically looking at the share price reaction after the deal is announced. Typically what you get with most M&A deals that are core business deals that are like acquiring so an oil and gas company acquiring another oil and gas company, you typically have a reduction in the share price of the acquirer. And that is due to many things, but usually there's an assumption they've had to pay a premium on the previous price, and therefore it might be dilutive or it might, quote, be expensive. That is probably overall a little bit more of a myth than a science. But what happened, and what happens very often in these tech acquisitions by non-tech companies, is the price of the acquirer rises because the markets are smart today. The markets know that all the value is in tech. And I'll just use one data point for that, and then we'll come back to this. 10 years ago, only it was only one tech company out of the top 10 companies by market cap in the world was a tech company. Only one. 9 out of 10 were non-tech, oil and gas, and retailers, et cetera. Today, 7 out of the 10 largest companies in the world by market cap are tech companies. And the value of tech has gone from whatever that one tech company was, Microsoft 10 years ago, 500 million, to now the 7 companies, a total of over $7 trillion. They're growing exponentially. So the data points are tech, and most people know this now because it's in the news, certainly with the 5 big tech companies. The tech companies are gathering up the value. It's not just the biggest tech. It's also unicorns, which are private companies valued at $1 billion, at least $1 billion. They have gone from something like 20 or 30 unicorns 7 or 8 years ago to over 400, nearly 500 today. And the total value of all the 500 unicorns is about $1.5 trillion. So this is real. It's not necessarily success. There's an argument to be made that they're overpriced and so on, but the movement is for real. There is real money going into these companies for a reason. So coming back to the share price of Lululemon, upon announcement of Mirror, the share price rose by 6%. If you look at the NASDAQ, which is where Lululemon would typically sit, it only rose by 2%. So one would argue, well, it went up by a net 4%. And the net 4% of that Lululemon share price rise represented about $1.5 billion of value. You subtract the 500 million, this is back in the envelope, subtract the 500 million that they paid for Mirror, and you get $1 billion of net shareholder value creation upon announcement of that deal. Of course, that goes up and down every day. And of course, that has to be proven over time. And of course, when Lululemon makes that deal for 500 million, they're not just hoping for $1 billion or planning for $1 billion increase. They want to make that 10 billion or 100 billion over the next 5 or 10 years. And that's why all this is so exciting. When you acquire like for like, you get what I described earlier, typically a depression in the acquired share price. It's acquiring market share or customers. It's not acquiring exponential growth and the kind of synergies that you can get when you see non-tech acquiring tech. So I don't know if that answers the question, but it's an example of how, when you get it right, how exciting this can be. And I'll just point out one more thing. You mentioned HR and employees and culture. So I have a chapter in my book about culture because I think it is so important. When you do the right deal like that, if it's done the right way, then one of the effects is that the employees in the non-tech acquirer can become very excited and inspired because if it's done right, they think, well, our leadership has vision. They see the future. They're taking risk. They're acquiring in something that may be a bit risky and maybe it's a high price. It's certainly not perceived by that in the case of Mirror when the share price of the acquirer goes up like it did, but it's some risk and they get excited by that. And many of the people who are real talent in some of the larger corporates who might be thinking of maybe leaving for whatever reason, and these days there are more reasons to leave, and one of the reasons is it's all these tech companies. growing and generating cash and being able to make attractive offers to people in the non-tech companies who are talented to come work for tech. Or maybe it's a unicorn, VC backed, that have options to offer, right? So there's a real temptation increasingly for the talented employees in non-tech companies to leave. Well, when the non-tech company makes an announcement of the right exciting deal, then very often some of that talent in the non-tech company say, maybe I'm not going to leave yet. Maybe this could be quite interesting. Maybe the management really does have vision and they're inspired and they're willing to take risk and they're going to grow this company in the right way for the long term. And I want to be a part of that. So it's just one of the things that people don't talk about that much when it comes to finance and M&A and deals, the soft impact, the intangible impact of culture and how people matter more than ever today. The war for talent is as strong as it's ever been. So it's a holistic thing. And I like to say these deals don't just create shareholder value, but it's stakeholder value. It's the whole ecosystem that one has to look at.
Let's get to the actual nitty-gritty then, because we've heard about about merger activities, we've heard about the press, we've kind of talked about the theory, but let's just go through the steps. How does a company like a Walmart or like a Lululemon, how do they decide we need to acquire something? And do they think we need to acquire something, or do they think I like that founder and I just want to work with them, so I'm going to buy it even if they've got a mushroom farm, I don't care? How does it work?
Great question. And it really does, it all starts in the beginning, and it is cause and effect, right? If you get the cause right and really understand why, then you're much more likely to get the effect right, which is the right company and the right deal. So the tendency for large corporates is to be very opportunistic when it comes to M&A, because it's typically core business buying core business. And, we know where most of the bodies are. We know where most of the companies are. We'll get interested when they're for sale. And typically they're represented by an investment banker, and they make the call and say the company's finally for sale or it's available. Are you interested? There's a lot of that. I mean, that tends to be the way it works. Now, if it's a tech company, it's an entirely different game, because the non-tech acquirer or would-be acquirer who is investigating the question wouldn't know where all the bodies are. There's over 450,000 technology companies in the world today who are, bona fide companies. It's not just someone who's filed for a limited company in their garage. And they're growing every day by about 100 a day, with about $1 billion a day being funded in these companies. So it's hard to find the right one. And by the way, geography doesn't really matter. You could be a German company and acquire a company in Iceland or Chile or Bangladesh. It just doesn't matter. So it's really a whole different environment for M&A. Now, the starting point, we say, was we have a 12-step methodology we created. Again, when we started this in 2017, we trademarked it, call it Techquisition. And the first step is one that we actually created a step 0, because we realized when we started talking to these companies that they weren't even ready for step 1. Step 1 is just to confirm with the board's assumptions around the parameters of the areas in the value chain that we've decided are the right areas to focus on. Many companies hadn't even done that. So they're interested in this theme. They had seen companies like Walmart or GM or JP Morgan or McDonald's make acquisitions and decide, it's time to really take it seriously. And we created a step 0, which is starting with 2 things: getting clarity on what parts of the company's value chain are the most fertile ground for a tech company acquisition in terms of enhancing stakeholder value, and where are the inflection points, getting clarity on that. And secondly, alignment, getting alignment among ideally the entire executive committee or executive board. It's very rare you get alignment on something like this, but we think it's very important. And so there's a process we go through to do that. It tends to take 4 to 8 weeks. It usually works, but it isn't so easy. It involves interviewing, some cases, 25 different executives around the world with different areas of responsibility, typically asking them about innovation and technology, the impact on customers, and so on. So that's the first step. And once we get clarity and alignment, then everything becomes possible. Then we can move into the next step, which is let's search. Let's look at the 20,000 companies in the world that could possibly fit in this priority value chain inflection point that matters the most, whether it's sourcing or distribution, logistics, or marketing, or on the consumer end, e-commerce, whatever it might be. Let's look at those 20,000 companies. This tends to take about 8 weeks. Then one narrows that list down from the 20,000 to ultimately a final list of 30. That's what you really want to have is enough companies to give you the possibility of having optionality, but and enough companies that you could actually call. Because once you get up above 30, it becomes very time consuming, very difficult. Even doing 30 is enough. Some companies we've only had about 10 shortlisted. And then when you shortlist those companies, you already know quite a lot about them because there's information available through websites, which happen to be outdated, by the way. So you got to be careful. Product videos, good, but outdated. Some companies, some of the best ones aren't even in databases. I found one today that I liked, and it was not in a major database that we use. It happens all the time, amazingly, even today. So once we get those 30 companies, let's say, the next step is to make a call. We suggest that someone like us or an agent makes the call.
Sorry,
not
I wondered, how do you make the decision who goes into that 30 list? Is it because you have a set of criteria that you believe is the right criteria, or is it because the client is thinking, okay, we want something very early stage, or we want something that's already got minimum X revenues?
It's always the client driving it because they tend to know what is right for them or what they want after we've done that first exercise. Or in some cases, companies have done the step 0 and the step 1, and they need some help finding the right companies. So they tend to know what they want. What we do is we help debate. We do the finding, and we will get the data, and we will do the debating, and also the questioning around the data. So a lot of the data is old, especially if it's a fast-growing company. These companies are doubling, tripling revenue, sometimes every month, if not every year or every quarter. So we're very careful in looking at the data, and we question, or at least we ensure that our clients are not assuming too much based on the data that they've seen. And that, by the way, one of the most important things for these companies is their product roadmap, which is not public. Companies don't publicize what they're going to do in the next year, 2 years, 3 years, but it's extremely important. So we have to make an assessment on what this roadmap might look like based on the trends that we've seen from their websites. You can go back and get the old websites, so you can see how they progressed. You look at the number of, for example, PhDs they have, or the type of papers they filed, or white papers, all kinds of things you can use as a gauge. Once you have that list of 30, then you've got to make the call. And we suggest, again, that an agent makes the call, not the company. And let's just pick a name out of the hat. We haven't talked to them. British Airways. If British Airways is going to make a call to a small tech company, or even a mid-sized, growing Series C, Series D tech company, and the CEO gets the call, the first thing he or she's going to do is, we just got a call from British Airways, and they're calling me, and they're talking strategic deal, not a commercial arrangement to license our software. That isn't necessarily a good thing for a large corporate to do because it sends the wrong signals or it makes messages. If an agent makes the call, then it's a call. We're representing a large established player in this industry who's looking for strategic company for maybe a joint venture or some type of relationship, but we have some questions. And then we don't know, or the target doesn't know who the acquirer is or the investor is. But because we've been doing this kind of thing every day for the last 30 years, we can do it very easily, is speaking to that CEO or that founder about all the things that the corporate partner need to know. I mean, why did you set up your company 10 years ago? What inspired you? Why did you want to change the world? What did you and your co-founder talk about? And do you like hiring people on your mission? Do you like firing people along the way? Do you like raising money? Do you like doing strategic deals? I mean, it's hard. How's it going in the family? And do you want to sell out one day? And if so, why and when and to whom? And all those questions. There's probably 100 questions we ask. And by the end of those 30 calls or meetings, we typically end up with a handful, 3, 4, 5 companies that are special and are going to be a very good fit, at least on paper, and including culture. And that's where it gets really exciting and really fun. So by the end of that process, now the corporate, the would-be acquirer, can start to feel comfortable that this is not going to be super high risk. And it's going to be the right price. It's not going to necessarily be the lowest bargain basement price, but it's not going to be the highest price either. It's going to be the right price. It's going to be a win-win price. And it's not just the price, it's the terms. And also by doing it that way, you're establishing a bond, an emotional bond between the two companies, between the executives in the companies. And that's extremely important, not just for the deal, but for the year, 2 years, and 3 years that follow the deal during the earnout. And the earnout should be really two-way. So what you're doing with 2 or 3 or 4 or 5 of these companies is you're making your decision on which is the right one. Sometimes you might do 2, or they come spaced out 6 months later. Many deals have happened at McDonald's if you look at what they've done. So you're building that bond that lasts beyond the earnout. If it's two-way, then you want to make sure that the corporate executives also are incentivized that the business plan is hit. Because if you do hit that business plan and the target hits its earnouts, then that's very good news for the acquirer. And so one thing that we don't see enough of is two-way incentives. It's one thing we work with our clients on where we can, where they're open-minded to that, because you really have a much greater shot at a super, we call it 100x win-win deal over the 3, 4, 5 years. So that's an overview of how we would advise our corporate clients to go about it.
So then once you've got those 5, then what happens? Because this to me looks like the exciting bit, the negotiations,
You're right. That's that's where you have to be very careful, because people love to be wooed, right? They love to be wooed. They love to be romanced. They love to be called on. It's very exciting, and it can go to your head if you're an entrepreneur, and you got to be careful. So if you're the entrepreneur, you got to be careful, be objective about it, realize it's early days. And by the way, you, as an entrepreneur, you really want to have these discussions all the time. So what I've been talking about is the perspective of the acquirer, the buyer, the partner. But from the perspective of the entrepreneur and the tech company, you want to have as many of these conversations as you can as a matter of course as you grow your business for commercial reasons and have commercial partners. And you also want to be exploring the idea that, these partners one day could be the company that buys you. It happens very frequently that a company McDonald's, they acquired Dynamic Yield last year for $300 million at I forget the exact revenue multiple, estimated 18, 19 times revenue multiple, but they'd been working with McDonald's for a year or two. So, it's quite likely that the companies that you work with as an entrepreneur to grow your business could end up being your exit. So you really want to be having these conversations and not to be overly, emotional, stay objective, realize these deals could fall apart at any time, including at the 11th hour for any reason. There are so many reasons why a corporate acquirer would pull out of a deal. There literally are 100 reasons, and very often it's because someone's left their job or someone's been fired, or we've just had an edict them from the board that we're not doing new deals, or it could be anything. So keep a level head, even as you get deeply into it and you're being wooed and you're being told, look, we've gone through a process, and there's only a few companies left that we are seriously going to want to negotiate with. But at that stage, if the corporate is doing it right, the deal would probably happen anyway, because you've already outlined we call it a chalk talk script. So the corporate brings in the whiteboard that's been in the boardroom for the last 3 months, that is the ecosystem of the two companies, and the target companies in the center of the whiteboard. And so that when the corporate walks in to the boardroom of the target company, the CEO or the management team of the target company says, well, John of the acquirer, why are we on the center of your whiteboard? We haven't even met before. We haven't even really talked. And the corporate can say, look, we take this very seriously. We've been studying this whole sector for the last year or 6 months, and you've been on this whiteboard for 3 months. You've been one of the key companies we've talked about as being critical to the things we want to do, but we're here to talk about you, not us. We want to talk about your dreams and your vision and your hopes, and how do you want to change the world, and maybe we can help you do that. We're here for you. We're here to help you. We want to partner. We're not here to buy you necessarily. We're, maybe it's an investment or a JV. It's about you, and we studied you because this is so important to us. Now, for most target companies, and I'm talking even about the Series C, D, E companies who have received tens, if not hundreds of millions of dollars in funding, they will not have had a meeting like this, because most of the meetings are high level, superficial. They tend to be about how much capital you need for what, by when, pricing, exit. They're not so much about how do we change the world together? How do we really change the game? How do we really make an impact? And that's what it's about, because that is typically 8 times out of 10 why an entrepreneur set up a company to begin with. They had a dream, a hope, a vision, excitement, inspiration. They want to change the world. And you know what? After 3 or 4 years of banging their head against the wall and going through 100 iterations, as Seth Godin says, it's time for a little help. We still want to do it, but we're exhausted. And we're running out of gas, or we've run out of money, or my wife has said, enough of these weekends. You got to come back to the family. It could be anything, but we need a little help. And no one should feel guilty about doing a strategic deal, especially if you're only selling a minority stake to a corporate. No one should feel guilty about giving up on anything, because it can help you get there faster. I guess talk to Mark Lohr of Jet.com, who sold his baby. Yes, it was $3.3 billion, but Mark could have built that to a $100 billion company or more. Everybody knows it. But he did the deal that he knew would get there faster, and it has worked phenomenally well. It's been a huge win-win for the Jet shareholders and for Walmart. And Mark has been running the Walmart e-commerce operation for years, ever since that deal closed, and has been extremely influential in the direction of Walmart. And we've seen a similar thing with GM acquiring Cruise, which was is a self-driving software startup. They acquired Cruise for $600 million back in 2016. The last financing round was done at a valuation of $19 billion. But what's interesting about it is it's kind of a reverse takeover, where the number 2 executive, Dan Amon of GM, went to run Cruise in 2018, become CEO, and the founders of Cruise said, great, that's great, because it means there's a higher probability that our software will now be on millions of cars, and millions of people will one day be enjoying our software, because that's what matters to these top entrepreneurs who want to change the world more than, believe it or not, an extra $1 billion. It really isn't what it's about. I mean, there's a price for everything, but to really get the win-win, I think GM has done a phenomenal job in how so far they've managed that acquisition as almost reverse, where GM, Mary Barr and Dan Amon saying, look, this is about you guys at Cruise. You're our future, and we want to nourish you and give you everything we possibly can over the next 5-10 years as we, GM and Cruise together, take a leadership role in the global automotive world. That's really what it's about.
You can join our live events, which take place every Tuesday, and ask speakers like Paul your questions. To do that, just sign up to our mailing list, and the link to that is in the show notes. And if you enjoyed this episode, which I hope you did, then it would be super helpful if you could give us a rating and a review. Each time we get a rating and a review, Apple's algorithm basically just bumps it up so other people can find this podcast and learn. And on that note, see you next week.